welcome to the Diwali special of Money, Money, Money. Our conversation continues. Last week, our experts told you all about equity investments. Now we're going to talk about everything beyond equity. What are the other asset classes you can look at as you aim to maximize your wealth this year, Samvat 2073? Let me quickly reintroduce my panel of experts. Of course, Ashish Shankar of Motilal Oswal is continuing to be with us as well, and market veteran Nilesh Shah of Kotak Mahindra Asset Management Company. We also have Gaurav Mashruwala giving us the financial planning and that expertise, that particular perspective, and of course Prateek Pant of Sanctum is still with us as well. So let me start with you, Ashish. Beyond equity, where else can money be made this year?
So let me start with fixed income. I think the last 3 years have been fantastic for fixed income investors as well. And we've seen interest rates being cut by almost 150 basis points. We've seen some of the funds which carry duration give double-digit returns. Even tax-free bonds, someone who had invested at 8.5% today is sitting on a nice capital gains. So it's been a good time for fixed income investors. However, going forward, I do believe that a large part of the gains has been captured. So within fixed income, I think it's a good idea right now to lock in yields either through FMPs or through funds which do a little bit of credit, apart from AAA, AA, single A. If you give it to good quality managers, you'll still be able to get a 7.5 to 8% return. So I think in fixed income, it's the time now to keep it simple, lock in yields and stay put for the next 3 years. A large part of the exciting part of the journey is over. We do believe that we are probably at the bottom of the interest rate cycle. Although, given the recent inflation number and the commentary from the Monetary Policy Committee, we may see one more rate cut, but the fall in yields may not be as much as we've seen over the last year or over the last 3 years.
Okay, so Ashish has obviously touched upon a really important asset class, and Nilesh, that's the question. Debt obviously has a significant place in the portfolio as well, right? So looking at the current environment, what's the right equity and debt mix that you think an investor, a typical retail investor should keep in mind? And then how to maximize the debt investment? Because as he mentioned, now this is no longer the time when you can, lock your money in an 8% plus FD, because those days are over.
So typically it's individual's risk profile which determines how much he should put in risk assets like equity and lesser risk assets like fixed income. But the thumb rule is that 100 minus your age is your allocation towards risk assets, and your age is your allocation towards non-risk assets. Now within fixed income, you could have government securities fund which are far less risky, and you could have credit accrual funds which invest into higher yield papers by taking credit risk. My recommendation this year will be to focus on credit accrual funds. They have a fair amount of spread over government securities fund, and as the pace of interest rate on the way down starts slowing down, the coupon income will become more critical, and hence credit accrual fund should outperform duration fund in next year. So focus on credit accrual funds.
But what about the risks associated? Because in the last 1 year, we did have 1 or 2 instances where there was a bit of a concern with some of these funds that were investing in a certain type of corporate paper, and some concerns came in. Because here one should remember that unlike an FD, here your principal is not necessarily always protected, right?
Agreed. See, most people focus on principal protection rather than return generation. Now, there was a time when FDs were giving 16, 17, 18% return. Then a time came when they were giving 9, 10 and 11%. Who knows, the time will come from current 7 and 8% level to 3, 4, 5%. Your reinvestment risk on FD is far more than your principal risk on FD. The second thing is also this perceived notion that fixed deposits are safe. As per law, the DICGC cover is available only up to a certain limit of, let's say, 100,000 rupees. Beyond that, it's a credit risk on the bank. And all of us are banking upon the implicit faith behind this banking system, which so far government has ensured that no matter what losses a bank make, the depositors don't suffer. So my recommendation is that don't just look at the principal protection, look at the overall return generation. Despite 1 or 2 mishaps which happened in some of the credit accrual funds, on a 3-year basis, on a 2-year basis, they have delivered fantastic return. Of course, on that particular day, it gives a crazy negative return, but you are here for 3 years. You are not here for 1 day. And on a diversified portfolio, I still think credit accrual funds will do better than the duration fund.
And typically, what is the sort of additional spread that one can expect when one is investing in these credit accrual?
I mean, as of today, the coupon spread between government securities fund and credit accrual fund is ranging between 200 to 250 basis points. That's a fantastic number.
So you can, of course, hopefully have
It's
much better
the,
returns. Yeah.
You know, in the top quartile of spread over last 5 years.
So that's the way to have sizable returns, hopefully in your debt portfolio as well. Gaurav, your thoughts? What's the approach to debt for you now?
So for me, it's more based on when would you require money as a planner. When are you going to have that cash outflow for whatever dreams, aspirations, responsibilities that you have? If you're likely to require money in next 3 to 6 months, stay in liquid fund or ultra short bond fund. If it's little longer, say 2.5 years, it could be debt funds. Maybe debt funds which are not kind of trading too much on the interest rate risk. Longer time, you may want to look at equity. So within debt instruments, you will also have to kind of diversification, because there is something which is needed immediately, somewhere you have time. Based on that, construct your portfolio. You can't get in a situation where you need money after 10 days and you're put into a debt fund where there is interest rate risk. So take a call based on your requirement.
Okay, Prateek, you mentioned for a lot of your clients, preserving wealth is more important than maybe maximizing returns. So in that context, given the fact that interest rates are heading down, we might have, as he mentioned, Ashish mentioned, another rate cut. How is your approach to debt right now?
Right. So I guess it's a mixture of different instruments which are available in the market. So I would tend to agree with what Gaurav said. If you're driven primarily by liquidity considerations, you would have to put money into ultra short bond funds or liquid funds, which actually allow you the next 6 months to a year without impacting a lot of entry and exit costs which are there. Because it's also important to look at, are there any loads in any of these funds when you're trying to exit, and what are the tax implications in these fund categories. Some of the newer...
So from those parameters, then what sort of a fund would you then recommend?
So as I said, if your duration, if your exposure is less than a year, you would tend to put money into ultra short bond funds which are there right now. There are some of the perpetual bonds which are also available in the secondary market, and some good corporates which have issued perpetual bonds tend to become an interesting option. In the past, a lot of our investors have invested into tax-free bonds and have reaped a fair bit of rewards because of the interest rate cycle over the last year or so. So options are limited, really, right? When we start looking at slightly longer term maturity is when we then go into medium term bonds or credit opportunity bonds, which Nilesh was talking about. One of the new categories which has emerged of late has been the AT1 bonds, or the or really the public sector bonds, which are additional tier bonds, which does tend to offer you about 100 to 200 basis point additional spread. Again, you have to be very careful about the type of instrument and who is advising you on that. We've had we've had these additional tier bonds offering from 14% coupon to 10% coupon, and how do you really take exposure into the right public sector? Because they do tend to be quasi debt type of instruments which have more preference equity type of tax treatment. So these are some of the instruments where you would take exposure when you're looking at this.
Okay, so those are the options you can keep in mind when you're thinking of debt over the next 12 months. We'll take a break. What about other asset classes? What about gold? What about real estate? That conversation on the other side. Welcome back. Here with the Diwali special edition of Money, Money, Money. We are discussing all sorts of asset classes that maybe you can maximize your wealth in this year. So, Nilesh, your thoughts on everything beyond debt and equity. Do you see money being made anywhere else?
So notional money can be made in many other asset classes, but we are talking about real money. So my recommendation is that in real estate, it's a location which matters. And ideally, if you can pick up a commercial property which can be put on a rent in that part of city where future city will be expanding. And if I have to illustrate it, if you had bought a property in Ballard Estate, Fort, Nariman Point, today probably you wouldn't be making as much money as you would have made in Bandra Kurla complex, because city shifted over there.
So the appreciation.
And in the meantime, you get your rental yield. So focus on a rental yield and focus on that part of area where city is expanding. I think that's the best way to make money in real estate.
Okay. We had an interesting conversation actually on property a couple of weeks back also on the show, where we had a property consultant come in and say, do not invest in real estate. So that was a bit of an eye-opener. But Gaurav, your thoughts in terms of real estate and as an asset class, will this coming year be any better than the previous one?
Difficult to kind of comment, but real estate as an asset class is, if it's from investment perspective, so not what is for self-consumption, is cumbersome to purchase, cumbersome to maintain, cumbersome to liquidate, and even cumbersome to bequeath. So be very, very careful before putting in that extra money. Also, invariably what happens is that one single large piece skews your entire portfolio in terms of weightage. So before looking at, and I'm not saying don't invest in real estate. The only thing I'm saying is be very, very careful. That should be the last on your priority. Once you have created enough assets, these are other assets are aligned to your requirements, there is enough liquidity, then consider, and as far as possible, stay away from leveraging. People don't realize, but that also creates a lot of problem. So real estate, not when you are beginning a career or when you're creating wealth, maybe at a later stage, but then you're only looking at appreciation. Again, rental income should not be the main criteria. So be very, very careful before you're putting money into real estate sector.
Okay, Prateek, in your experience, when this is an asset class that's completely bombed in the last couple of years, it's not offered liquidity or returns, do you see any of that turning around? What are you telling clients?
So we have a slightly different view around real estate. You know, if you actually look at the evolution of real estate now, it's primarily been a transactional asset class, right? Where people have gone and bought you've gone and bought primaries. There's a pre-launch happening somewhere. We've had clients who've had 15, 20 of these real estate, portfolios, and today they find it really very difficult to maintain. We are seeing progression of real estate from being a transactional asset class to actually a yield asset class over a period of time. More and more of our clients are really looking at consolidating their real estate portfolio holdings. So they do not want to hold 20 primary residential units, but actually then go and buy 2 good quality commercial office premises, which can actually give you good quality yield. They tend to build a diversified real estate asset class where you may have a hospitality asset, you could have an education asset, you're having a commercial office space, and not just in one location because you're based in Bombay. You could be buying something in Bangalore, you could be buying another thing in Pune. So we are seeing with the type of private equity and institutional money coming into real estate, this is actually going to move away from being a classic speculative asset class to a core asset class in many client portfolios. Of course, with REITs coming in, simplifying that for a lot of not necessarily the super HNI clients, but even many of the retail clients, to be able to offer a good yield proposition in their portfolio, which was so far only on the debt side, is going to be an important step.
Nilesh, your thought, because maybe the next 12 months will actually see this instrument finally take off, real estate investment trusts. Is it something in its current avatar and the way the market is it something you think retail investors should consider?
So investors should keep their eyes and ears open. It's quite possible that in order to popularize real estate investment trust, first few offerings are priced above the market. That's your benefit. But if those assets are not priced properly, then there could be serious trouble. I have seen in my individual capacity some of the rental yield assets where initially the rental offered is very, very high in order to capitalize it at a much higher value than what is the market value. Now, if such kind of things are going to get repeated, then there's no point in investing, because what you make in a higher rental, you will lose far more in capital.
Okay, fair enough. Ashish, your thoughts. Real estate should find a place in the portfolio right now.
So, I mean, I believe that real estate as an asset class is really for the ultra HNI or the sophisticated investor for 2 reasons. One is, the size of the ticket. If you want to effectively diversify in real estate and end up buying some residential properties or some commercial properties, the amount of money that you need to lay out is quite large. So I believe as an investment, it's only for the sophisticated or the ultra HNI investors. Second, the process of due diligence is underestimated in real estate a lot of times, because most investors, they buy whatever comes their way. So, the hot pre-launch, or, some developer who's advertising very heavily, and, the agent lands up in your office and you go and, buy that property. However, like Nilesh Bhai just mentioned, even in a commercial real estate, there are two aspects. One is to look at the rental yield. The other is also to look at the absolute value of that asset class.
Right.
Because if you end up buying based on rental yield, then you can buy it at an inflated purchase price, which means for a long time, you may get your rent, but finally when you liquidate your asset, you will not get any capital gains.
Sure.
So I think you have to look at both. But having said that, at this point in time, I think the commercial rental yield real estate part of the real estate business looks very interesting. And a lot of sophisticated investors are looking at building a portfolio around that.
Okay, all right. We'll take a break on that note. On the other side, we'll come down to some last thoughts. Which are the best asset class picks to look at, and some thumb rules of investing. We'll have Gaurav give us some of those ideas as well. So we'll be back in a moment. Welcome back here with the Diwali special edition of Money, Money, Money. We've been discussing all kinds of wealth generating ideas, different asset classes. Now it's time to come down to some final thoughts. And for that, Gaurav, I'll start with you, because earlier in the conversation, you gave a bit of a reference to these terms. WPI with a twist, IIP with a twist. Some basic rules of investing that one should always keep in mind, right?
What I was talking about is basics of financial planning.
Financial planning, rather.
Yeah, so I'm saying start with your goals, but so people are more concerned about country's GDP. You should be, what is your GDP? Goals and dreams plan. Or
The goals and dreams plan, your own GDP, focus on that.
Exactly.
Okay.
What are your IIP numbers? Investment income plan. Where is money coming from? Where have you invested? Is it going to take care of your goals when you need them? Because no point having investments which are illiquid, and then that's creating problems.
So focus on your monthly IIP number, focus on your GDP. What's next?
Stop EMI and start EMI. So
Stop EMI and start?
So stop paying EMI, start investing in EMI. So basically what I was talking about is get out of loan as soon as possible, because when you're paying loan, equated monthly installments, there's certain interest component, which is your expense, and get into equity monthly investment, which is like, going to build asset for long term. I also spoke about WPI. So where I was saying that wealth passing instruments, where I'm saying is nomination in place, do you have your will in place, because people don't have that now. No point building up assets, a brilliant portfolio, but when it comes to inheritance, your family is stuck. I mean, that doesn't make sense. Similarly, conduct your AGM with your family.
AGM.
Yes, because again, I've seen this will be time and again that the person who's handling, it could be the male member, it could be the patriarch, or now in nuclear families, even wife, but then the other members of family are not aware of it. So even if you have a health insurance, which is brilliant, but the person who's in know of it is
should know
ill,
about it, yeah.
but other persons don't know, they don't know. So look at that, look at your quarterly results. So go for quarterly. In fact, I also say that couple go on quarterly dates, financial dates, and kind of
Financial dates, oh my God, I don't know how that idea is going to go down. But interesting thought.
Yeah, because I'm saying,
take your balance sheet, your family balance sheet along with you over the candlelight dinner.
Yeah, I mean, in every quarter spend 2 hours. I'm saying yearly spend 8 hours where the entire family, or at least spouse, husband and wife, know where are the finances, where is income, where are the when new goals are coming in, do we have liquidity easily available? I mean, there are a whole lot of it. Your CEO, contingency and emergency option, if contingency was to come in, where is that money? So people keep looking and discussing the country's GDP, the IIP, the WPI, what's happening. Are you aware of yours?
Of your own acronyms. It's very important to keep that in mind. Nilesh, final thoughts from you as well. Have you seen the retail investor get a little more mature over the years? We haven't heard of too much of redemption pressure, for instance, the entire last 1 year, even when the market was falling. And any other tips that you'd like to leave people with?
Times have really changed. There was a time when in market correction, I used to tell investors, "Ghabrana mat, theek ho jayega." Now, time of correction, people are telling me, "Nilesh bhai, darna mat, theek ho jayega." So retail investors have really matured. One, they are investing for longer term, and we are seeing average holding period of our investors increasing day by day. Second, they are investing via SIPs. As a mutual fund industry, we have more than 1.1 crore SIPs, bringing in about 3,500 crore every month. So kudos to the maturity of retail investors that today we are becoming more bullish about market. We are getting our conviction stronger about the market. My tips to the investors is very simple. Making money is very, very simple, but it's not easy. The simple rules are long-term investment, a decent asset allocation, and regular investment. These are very simple things to follow, but it's not easy to follow.
And we'll end by letting the wealth planning experts, so I'm going to give you $100. Let's say if you have $100, divide all of that in terms of allocation across any asset class that you wish to put it in.
Well, I think if you have a longer term time horizon, beyond 3 years, I would say that I would put maximum amount in equities and keep some money aside for liquidity or any emergency needs that you have. So I would go with a 70% allocation to equities and maybe $20-30 split into fixed income and some amount in liquid assets.
Okay.
But I think equities is what is going to create the maximum wealth for you over the next 3 to 5 years.
Okay, Prateek, medium risk profile investor, $100. How do you split it up?
See, going with the theme which my colleagues have said here, the eighth power, they talk about the eighth power is the power of compounding, right? So if all your growth capital should be in equity and equity-linked instruments, and then whichever way you want to generate some sort of income is where debt or the real estate investment trusts or any other of the yield assets will come into play. So it would roughly, for a medium risk investor, it would be a 50% growth capital and 50% which would be in debt and yield instruments.
Well, on that note, I'll take this opportunity to thank all of you gentlemen. Thank you so much for your time and your patience and for sharing those amazing insights with all our viewers. Season's greetings, happy Diwali, and we wish you a very prosperous new year. And that's exactly what we wish our viewers as well. Thank you for keeping it with us. We'll keep getting you more ideas on money, money, money.